Welcome, everyone. Looks like we've still got a few people joining, but I think we want to go ahead and get started just to be sensitive to everyone's time today. Thanks for joining us for this discussion about theft loss deductions, particularly in the context of online scam transactions or scam situations. My name is Eric Lanning. I am counsel at Frost Law. I work in the tax planning and tax advisory areas of the firm. I'm joined by Heather Posey today. Oh, there we go. We're flipping through bios. Joined by my colleague Heather Posey.
Hi, thank you, Eric. Like Eric, I'm also an attorney here at Frost Law, and I'm an EA. I have been in tax compliance, tax controversy for a bit over 10 years, and I am very, very excited to share our experience and our expertise insofar as it relates to theft loss deductions. We can skip this disclaimer.
Yeah, and just real quick, Heather, I've seen a couple of questions in the Q&A about a handout. I believe we're making this available after the presentation. Is that correct?
I'm not sure.
Okay.
I thought they were going to
Do
upload it
it.
into the chat, but if
Okay.
not, then they can send it out after.
Okay.
All right. So today we're going to be talking generally about the theft loss deduction as it relates to some of the most prevalent scams and schemes that are out there right now. There have been a lot. We have seen a lot of very sophisticated, complicated scams where people are losing enormous amounts of money. And while it doesn't really get their money back, we can at least try to obviate some of the tax consequences that may result from individuals who are taking large withdrawals from retirement plans to be able to fund these like scams or just kind of try to recoup from a tax perspective a portion of the loss that they incurred. So we're going to talk about how theft losses in general are treated under the current tax code and how some of those theft losses may be able to be deducted. We're going to discuss the recent IRS guidance about certain theft loss deductions. We're going to evaluate what the actual legal criteria is for being able to deduct a theft loss. We're going to explore just some of the potential issues that can arise either by virtue of taking the deduction or by virtue of just being caught in some of these scams. And we're going to finally talk about some of the current challenges that we have experienced in defending theft loss deductions before the IRS and just kind of what the IRS's viewpoint on it is. So as a baseline, Section 165C provides this framework for individuals and businesses to be able to deduct certain theft losses. And there are three different types of theft losses that are described in the code. Under C1, these are going to be thefts and losses that occur within a trade or business, like when someone is engaged in a trade or business and they suffer a loss, a theft loss specifically, that is covered by C1. Then with C2, there are losses that are incurred in any transaction that's entered into for profit, but is not otherwise connected with a trade or business. And this is more so like investment type transactions. And then in C3, there are losses of property that are not connected with a trade or business, are not connected with a transaction entered into for profit, but those that arise from like a fire, a storm, shipwreck, any other casualty, or from theft. These are generally considered like personal casualty and theft losses. And you used to be able to deduct those in full, just like the others, but under TCJA, the losses that were like these personal casualty and theft losses were no longer deductible, except for those casualty losses attributable to a federally declared disaster. And OBA made that change permanent, although it tweaked it just a little bit to say that you can take a personal casualty loss for losses attributable to either a federally declared disaster or a state declared disaster, because of course, state governors and officials are normally much faster to act when it comes to certain disasters. So rather than waiting or relying on the federal government to declare all these disasters, it can also be a state declared disaster.
Yeah, and we just had a quick question, and we'll try to hit these as we do. Just the history of that, of the 165C3 suspension that Heather mentioned. It was initially limited under the Tax Cuts and Jobs Act of 2017, which limited the availability of that deduction for tax years 2018 through 2025. And then in the One Big Beautiful Bill Act earlier this year, that the subsequent changes were made. So as Heather pointed out, that sort of limitation of the deduction was made permanent, with the caveat that state declared disasters were also eligible. So those are the acronyms that were referred to: Tax Cuts and Jobs Act and One Big Beautiful Bill Act. So
Yeah.
all right. So as Heather mentioned, we've got a statutory framework for loss deductions, and we're going to talk a little bit later about the phrase, or what we sometimes refer to with clients as the magic words in 165C2 of transaction entered into for profit. There's a lot of case law on how that's defined and how to think about that. But in general, for when we started to see these sorts of schemes come onto the scene and over the last few years, at least prior to earlier this year, there was no real guidance that the IRS had provided on how to consider losses from some of these online investment schemes, or phishing schemes or things like that. And so what we were doing, in our practice was originally looking at what we think of as the Ponzi scheme ruling. So in 2009, the IRS issued Revenue Ruling 2009-9, where they confronted the question of deductibility of losses from a Ponzi scheme, so an investment fraud scheme perpetrated by an individual on multiple investors. In that ruling, the IRS kind of analyzed the concept of a transaction entered into for profit under Section 165C2, as compared to the more general theft loss under 165C3. Under that ruling, or in that ruling, I should say, the IRS determined that the financial advisor involved had committed a crime under local law, criminal fraud or embezzlement, some form of theft crime under local law, which is what's required at the federal level to kind of get over the threshold of what is a deductible theft loss. You have to have a theft under local law. So the IRS determined that did occur, and that the loss was deductible under 165C2. Now, in 2009, we didn't have the limitation on the 165C3 theft loss that we did after 2017 in the Tax Cuts and Jobs Act, but there are some differences in the way 165C3 and 165C2 apply. And so it was meaningful at that time and in that ruling that the taxpayer was eligible, or was able, to take that deduction under 165C2, primarily related to some limitation issues under 165H. But again, at that time, the IRS ruled that loss was a deductible loss under 165C2 as a loss from a transaction entered into for profit. Subsequent to that, the IRS issued Revenue Procedure 2009-20, which we affectionately refer to as the Ponzi Scheme Safe Harbor Procedure. And this essentially lays out a scheme where an individual who meets the requirements can take the deduction with a bit of a haircut. 95% of the loss generally is the deduction. There's another limitation that takes it down to 75%. We don't talk a ton about this because generally individuals that we work with in these online schemes don't qualify for the Ponzi scheme safe harbor, and we'll talk a little bit more about that later. So as I mentioned, that we were dealing over the first kind of year that Heather and I were looking at these issues. We really didn't have any current guidance from the IRS, so we relied a lot on Section 165C2 case law as well as the prior 2009 revenue ruling. Or earlier this year, the IRS issued Chief Counsel Memorandum 2025-11015, which essentially talks about 5 different types of scam transactions and analyzes the deductibility of losses related to those transactions. And so there's a lot of text here, but we will kind of go through this at a high level. In that CCA or CCM, excuse me, the IRS talked first about a taxpayer in what's called a compromised account scam or an impersonation scam. And this is where an individual is contacted by someone purporting to be customer service from a financial institution or a fraud department or something. And generally that scammer is going to tell the person, the individual, the victim, that their account has been compromised, that there are scammers that are watching the accounts or who are ready to steal the money in the accounts. And this individual tells the victim, you should transfer your funds to a secure account. Here is a secure account that you can transfer your funds to. Now, in this situation, that so-called secure account is actually an account of the scammer. And so we lost the slides there, Heather.
Oh God, sorry. Is it still there?
Yeah. And I saw the question pop up. It's 2025 11015. That's okay. Chief Counsel Advice Memo 2025 11015. So back to this, in that kind of compromised account scam, essentially what happens is a scammer convinces the victim to transfer their funds to another account. So the victim actually initiates the transfer. They're making the transfer themselves. And what the IRS said about that, and this is going to be important for that concept of transaction entered into for profit, but the IRS basically said, look, although that move of the assets is to safeguard them and not to invest them by virtue of that very transaction, those assets were originally invested or set aside with the intent to make a profit. So trying to safeguard or reinvest those accounts continues the characterization of it being a transaction entered into for profit. And that's consistent with case law construing Section 165C2, where courts have said, look, you look at the entire transaction. So in this case, if an individual intended to save assets for retirement or investment, actions that they take to safeguard those assets continue to be within that profit motive. So at that point, the IRS said that this loss would be deductible up to the taxpayer's basis in the property, which is generally the measure of the amount of the deduction. So example 2 is kind of the one that Heather and I see the most, which is colloquially referred to as a pig butchering scam. In this case, the individual victim is convinced by a scammer that they have the opportunity to participate in some sort of investment opportunity. It's generally a secret opportunity that not many people know about. The victim is often told they must keep it secret because they're being given an opportunity that is not available to everyone else. What happens is the victim will contribute money. They are shown a fictitious investment platform. They see that there are positive investment results, which encourage them to invest additional funds. At the time that the individual attempts to make a withdrawal, they will not be able to make the withdrawal. Victims are often told that either they need to prepay the tax on the appreciation in the assets, or that they need to pay some sort of security deposit or other fee in order to unlock the assets. These of course are just additional ways that the scammer is trying to get money out of the individual. Um, you know, one of the notes here is that in this particular case, in the CCM, the law enforcement investigation confirmed that the funds were not recoverable. That again is we'll talk about that in a few minutes. That's a prerequisite for deductibility as well. So in that case, because the individual thought that they were making investments either for their own retirement or other purposes, the IRS concluded that that would be a transaction entered into for profit. And again, the loss would be deductible up to the amount of the taxpayer's basis in the property that was lost. And then we're going to get example 3, the phishing or impersonation scam. This one's a little bit different, and kind of the salient point here is that in this scam, the taxpayer is not normally directing the transfer of assets. So in the other two examples, whether a taxpayer is trying to safeguard their assets or whether they're trying to affirmatively invest them in these investment schemes, the taxpayer is making an affirmative decision to take a withdrawal from an IRA, for example, and to reinvest those proceeds. In the phishing or the impersonation scam, the individual is not making that withdrawal. They are tricked or otherwise induced into giving the scammer access to the account, and that scammer would move those funds out of the account without the knowledge or consent or action of the taxpayer. So this conclusion's a little bit different, and it depends on kind of the nature of the assets and the exact steps of what happened. Because what we see a lot here are situations where our client, the victim, has taken money out of a retirement plan or an IRA. So they've got a tax issue occurring. But we've been talking about, it's noted in this slide as well, that the deduction is keyed to the taxpayer's basis in the assets. And what the astute tax professional will know is that an individual does not have a basis in pre-tax accounts. Your basis in an IRA, pre-tax IRA, or a retirement plan is zero. And so when those assets are stolen, there may be a deductible theft loss, but the amount of the deduction is zero because the basis is zero. So there's almost a little bit of optionality in this third example where the IRS says, look, you have to determine, did this individual have any basis in the assets? If they didn't, the deduction is zero. But importantly, the IRS, and this relies on IRA case law from the tax court, the IRS says if this individual did not direct the withdrawal of those funds and they didn't receive the funds either actually or constructively, the scammer just went in, took the money out of the account, then generally that taxpayer is not going to have to include the amount of that distribution in income. So they don't really suffer from losing the ability to deduct the loss because they don't have to take the amount of the distribution into income. So there's a little bit of a little bit of interpretation needed in a situation like that, but generally it's not going, in the event that there is a recognition event and basis in the property, the taxpayer would have a deduction in that case. So example 4, if we get there, this is the romance scam. This is the 90-day fiance type example for those of you fans of reality TV. Essentially, when our victim, our taxpayer, believes that they are involved in a romantic relationship with an individual and they send funds to that individual for the use or benefit of that individual, so of that scammer, that is not a transaction entered into for profit. That individual is sending that money to the scammer out of perceived sense of affection or otherwise, and not with the intent to make a profit. So that loss in that case would not be a deductible loss under 165C2 because the taxpayer's motive wasn't to invest those funds. It might have been to pay the purported romantic partner's medical expenses or pay expense. We've seen requests for expense to help pay expenses to obtain a visa to come see the victim. So these are fictitious stories, but the victim in that case is not motivated by the investment intent, and so there's no deductible loss under 165C2. There would be a deductible loss potentially under 165C3, but because of the changes in the Tax Cuts and Jobs Act, solidified or made permanent by the One Big Beautiful Bill Act, there would be no deduction for this individual. Now, just a quick caveat: in probably 60 to 70% of the cases that Heather and I work with, the victim's initial contact with the scammer is social or romantic in nature. Oftentimes, that scammer will be met on a dating site. But what the IRS is clear about in the CCA is that if a relationship with a scammer begins as romantic but transforms to an investment sort of focus, so they're developing a romantic relationship, the scammer, the purported romantic partner, says, "Hey, I'm involved in this investment strategy. I'd love for you to get involved. We can invest for our future together." In that case, where the motive of the victim is investment related, the presence of a purported romantic relationship is not going to affect the deduction. So again, if they're sending money just to benefit the scammer, their purported romantic partner, that loss would not be deductible. But if the scam begins with a romantic connection and converts to an investment related activity, the scenario 2, taxpayer 2, the pig butchering scam, those losses would nonetheless be deductible. Then the last one, example 5, this is the kidnapping, kind of the extortion scam. Again, what the IRS focuses on here is the fact that the taxpayer is not motivated when money is lost, when money is given for this fake ransom. The taxpayer is not motivated by an investment motive. They're motivated by the love or affection for their family member or other loved one that they believe is in danger. Or in an extortion or blackmail scam, they're motivated by other reasons. But in this case, the IRS would say there's not a motive to invest any of the funds, and so there's no deductibility under Section 165C2. So I just one real quick point on this as well, Heather. We have found the CCA to be very, very helpful and very useful to our clients. That doesn't replace the need for advice. One thing we're going to talk about in a little bit is the kind of lack of widespread knowledge in some cases about the Chief Counsel Advice Memorandum, and so it's still important to kind of think through these issues. And this, as people will know, Chief Counsel Advice Memorandum is not binding guidance, so the IRS is not bound by this memo. They could take a different path with a particular taxpayer. We have not seen them do that yet, but with the lack of binding guidance, that's potentially a concern.
Yep. All right. So next, I want to get into what can essentially be seen as a checklist for whether or not certain types of theft losses can be deducted on someone's income tax return, and specifically under 165C2. So the kind of threshold question is whether these losses were incurred in a transaction that was entered into for profit. And this, in my opinion, is the most important part of the analysis. Like, what did the victim intend to do with that money when they transferred it, either to, specifically to a purported individual or to an investment type platform? What was their intent? Was it to invest that money and receive profits, or was it to pay off a ransom? Was it to give a gift to a potential or purported romantic partner? We need to analyze whether they actually engaged in sending that money with the intent or the hopes or the expectation of receiving a profit as a result. Sometimes this becomes a little bit difficult because, as Eric said, many of these scams start as social or romantic in nature, where the scammer reaches out to the victim either unsolicited text message or on a social media platform or on a dating website, and they begin this connection with the victim. And in the classic pig butchering scams that we see, normally the scammer will, like, after a few days or maybe even weeks of talking to the victim, will start to casually mention that their job is being an investment advisor, or that that's like kind of what they do, that they're very wealthy, that they take these expensive trips, or here's all the cars that I have, or I have a house here and a house there. And they'll like subtly mention their own wealth and then start mentioning the investments that they do. They'll say, oh, the stock market's looking great today, or the gold market's doing really well, or my crypto investments are really paying off, to kind of bait the victim into asking about it. And then the scammer will say, oh yeah, I'll teach you. Here's how you do it. Make this account here, make this account here. Now make a wire to this address or to this cryptocurrency wallet, and then transfer it to this website. And that's kind of where what is essentially like this line of demarcation between it being social/romantic and it being actually a transaction entered into for profit, because the scammer is bragging about their investment success and is saying, hey, you can do it too. The victim is induced, say, oh yeah, I would love to make more money. I would love to be independently wealthy, et cetera, et cetera. And then that's when they start kind of making these transfers. But we've also seen some cases where it starts as a transaction entered into for profit, but then starts to move away from that profit motive, that maybe the victim was essentially like maybe cheating on their spouse with the scammer. So now maybe the scammer might kind of hold that over their head and say, if you don't like deposit into this account or keep depositing or keep investing with this platform, then I am going to contact your spouse, let them know that you are cheating, or like some type of extortion. Or maybe the scammer says, oh, I need money for surgery, et cetera, and the victim sends them money for that. There's like this analysis that you have to do, essentially this micro analysis for each transfer of, was this transfer done with the intention of realizing a profit? Like, was this one done to the investment platform in the hopes of receiving a return? Or was this one as a result of an extortion attempt? Or was this one because of personal romantic reasons? And again, I want to note that in these situations, like the impersonation scams or the compromised account scams, if the victim is contacted by the scammer and is otherwise induced to transfer pre-existing investment assets that they have into this safe account, because purportedly their account has been compromised, that initial for-profit intent is going to remain, even though their specific intent of making that specific transfer of liquidating their retirement account or their CD or their savings, et cetera, and transferring it to whatever account they have been directed to by the scammer, is still going to be a transaction entered into for profit. So when we meet that prong, then we have to look at the actual conduct of the scammer. And that conduct, in order to be considered a theft loss under federal law, the conduct of the scammer has to be considered a theft under state law. Now, with these situations, normally it's done online, it's not in person, but it's done online. So really the state law that you're looking at is the state where the victim resides, because that is essentially where the perpetrator, like by contacting the victim who lives in that state and by inducing the victim to take these actions within that state, the crime happened or could be prosecuted under the laws of the victim's state of residence, like where the victim was when these actions occurred. So what we do and what I would suggest is first searching the state theft law statutes for the victim's state of residence. Each state kind of has a unique structure for their theft statutes. Some it might be called theft, some it might be called larceny, and then some they're going to have like these sub theft crimes where it will be like theft by swindle or false pretenses or larceny by false pretenses or something of that nature. I'm going to be looking for false pretenses, um, false promises, impersonation, something of that nature, usually. And then what we do as well is to make sure that the scammer's conduct would be considered a theft under that state's law is once we find the theft statute or statutes, then we try to search criminal cases to see any time that maybe the state used that law to prosecute or charge or convict a defendant of that theft under, like, based on similar conduct. With a hurdle that we face a lot is with many of these cases, like pig butchering and these types of scams, they're generally investigated and prosecuted on a federal level. State investigators, maybe don't have the resources, maybe don't have the jurisdiction to investigate and prosecute these types of online theft scams. So it would be very, very difficult to find a case where this exact type of pig butchering, etc., conduct occurred. So I normally try to search similar conduct, like some type of investment scam, sometimes Ponzi schemes, maybe anything related to cryptocurrency or scams, something of that nature, to try and find conduct that is at least like similar or analogous. Like, oh, this person induced, this defendant induced their victim to give them money by stating that they would invest the money for the victim, but they actually kept it for themselves. Something like that is good enough to know for sure that the scammer's conduct is going to be considered a theft under state law, and that is going to meet the federal requirement of the conduct being considered a theft under state law. So next, you need to determine the actual amount of the theft loss that is able to be deducted. The most important part of this is knowing what the taxpayers or what the victim's basis in the money stolen was. Because when it comes to theft loss deductions in general, someone is only able to take a deduction up to the amount of their basis in that asset. That is essentially your basis is going to be like the amount that you paid to purchase that asset. Like it's normally used in the concept of maybe stocks or real estate where you pay, maybe $200,000 for some stocks. If the stock's value increases to $400,000 and then it is stolen, even though that stock was worth 400,000, you are only able to deduct up to your basis in that stock. So you would only be able to deduct $200,000.
Yeah, the way to think of this, I would say, Heather, is just your cost in the assets.
Yeah. So oh, go ahead.
Nope, please.
Oh, okay. So when it comes to these types of scams, most often individuals are using like liquid funds that they have available to them, like money in a bank account that's not much, there's not much of an issue there in terms of basis. Like your basis in that asset is going to be the actual value of the money in your bank account. But it becomes an issue when someone is taking money out of either a pre-tax account or a post-tax account, or if they are transferring cryptocurrency, gold, foreign currency, etc., that they already owned, even if the value of it has increased substantially since they initially purchased it, their deduction is going to be limited to their basis, essentially what they spent to acquire that cryptocurrency, that gold, that foreign currency, etc. With retirement plans, if it is a pre-tax retirement plan, like a traditional IRA, a simple SEP IRA, a 401k, other types of these tax-deferred retirement plans, the whole structure of a tax-deferred retirement plan is that when you are contributing to that account, that money is not, you are essentially reducing your taxable income or your gross income by the contributions to that account. It grows tax-free. You pay taxes when you withdraw it. But with post-tax accounts like a Roth IRA, a Roth 401k, etc., you are using post-tax money to contribute to the account. You are not receiving a deduction or any kind of reduction in your gross income as a result of the contributions. The money continues to grow tax-free, and then when you take it out, it's tax-free. So when someone is taking a withdrawal from a post-tax account in order to fund these scams, their deduction is going to be limited to their basis in that withdrawal. When it comes to pre-tax accounts, aside from situations where the taxpayer does not actually direct the transfer of those assets, like if someone breaks into their retirement account and just makes a transfer out, that is not taxable. But in every other situation where the victim is the one withdrawing funds from their retirement account in order to make a transfer to the purported like scam platform or to the scammer, etc., that withdrawal is going to be taxable income to the taxpayer. And in that situation, that is going to essentially like give them a basis in that asset. So that's going to, even though that it is a pre-tax account, as soon as they take that withdrawal, it becomes taxable, and then they have enough basis to be able to write off the amount of the loss. I know this was an incredibly complicated way to explain the basis issue in determining the amount of the loss, and that's only half of it. The rest of it is actually figuring out how much did they transfer to the scammers, how much did they transfer to the purported investment platform. Oftentimes, we will include wire fees as well. So if someone is wiring $100,000 to this purported investment platform, and then they are separately paying to their bank with $20, $30 in wire fees, just kind of incident to that transfer, then we kind of include that in the amount of the loss. If someone tried to pursue recovery or did pursue recovery and was able to possibly obtain any recovery outside of recovery scams, we're not dealing with when someone receives a message saying, oh, hey, I know this person, they will get your money back, et cetera, because those are usually scams. And that's not what I'm talking about. I'm talking about when someone is actually able to obtain a partial or full recovery of their loss, and they hire possibly an attorney, or something of that nature to pursue some type of recovery, the cost of recovery is also included in the amount of the loss. Just as a note, like I mentioned with the basis conversation, the whole reason that I had that is because any unrealized gain, meaning any growth in the value of that asset that exceeds someone's basis in that asset, is not going to be included in the amount of the loss. We did have someone who had existing cryptocurrency and they purchased it many, many years ago for maybe $3,000, and it was worth $600,000 at the time of the scam. But because their basis was only 3,000, they could only take a theft loss deduction for that $3,000, despite losing out on, $600,000. All right, the next prong, I'm going to try to go a little bit faster so we have time for Q&A. The next prong is, when is the theft discovered? Because the theft loss deduction is taken in the year that the loss is discovered. And sometimes the year of discovery may not be the same year as the year of the theft. Maybe someone starts talking to the scammer in 1 year and making transfers, et cetera, but it's not until sometime in year 2 that they start to realize, okay, this is actually a scam. I'm not going to do this anymore. In that situation, year 2 is when they are going to take the deduction. Even though they had losses in year 1, they're just going to take the entire deduction in year 2. And sometimes this can create some issues where someone takes withdrawals from a retirement plan, incurs a large tax liability in year 1, but doesn't discover the theft until year 2, because they're not really able to offset the tax liability incurred as a result of year 1's retirement distributions. Like everything just goes on year 2. So
Yeah.
that can create some IRS collection issues.
Yeah, to add to that, Heather, I mean, that was another change from the Tax Cuts and Jobs Act in 2017. The theft, or excuse me, any loss deduction carryback was eliminated.
Mhm.
And anybody who follows those rules know that they change all the time. But right now, theft losses cannot be carried back. So if someone has a large income event from a distribution in December, but doesn't discover the theft until January, they're going to have a mismatch there of income and loss deduction. So they're going to have to use that loss deduction to offset other income going forward, but it won't be able to take away the big income event.
Yeah, and that really creates big issues because it can be difficult to pay the taxes on a $500,000 retirement plan withdrawal when you didn't actually receive that $500,000. So I think that's another place where we, or any type of tax advisor, can provide some assistance in terms of working out something with the IRS so that someone is not getting in trouble or having their accounts levied, et cetera, as a result of this. So another part of the year of discovery test that some courts look at is they ask, when would a reasonable person have discovered the theft? The court does not want, or tax courts do not want someone to intentionally delay taking a deduction just to say, oh, well, I actually discovered it in year 3 because that's when I took the most money out of my retirement plan, or that's when I, maybe have a bigger tax liability for whatever reason. They're looking at, when did the taxpayer discover the theft, and when would a reasonable person have discovered the theft?
Yeah, and
But
we see that
again,
all. Yeah, we see that issue kind of the other way around, right, Heather? So someone may have a big income event in December and then sort of say, well, I suspected that it wasn't, really legit, but I contributed additional money to try to recover my funds in January. Maybe the money in January in that example wasn't given to invest, but was given because the person was told they had to pay tax. And so we've had situations like that where someone would say, look, I really knew it was a scam. I discovered the theft in year one, so I should be able to take that deduction in year one. So that's the real challenge. And what we've seen and what case law kind of supports is that if you can't argue that the theft was discovered in year one if you contribute additional money to the scam in year two. So it's a little bit of a challenge.
Yeah, yeah, because a reasonable person
Right.
would not have done that. So something that we normally look for, just to kind of substantiate the year of discovery issue is many victims will file like a police report, a report with the FBI, the SEC, the Attorney General, the Consumer Financial Protection Bureau, Federal Trade Commission, Consumer Federal, no, Commodities Futures Trading Commission. They will just file law enforcement reports in the hopes of reporting the scam, maybe having someone in the federal government investigate the scam or the local government investigate the scam, etc. And that for me is kind of a nice dividing line of this is when someone definitely knew that they had been the victim of a theft. And then finally, you need to analyze whether there is a reasonable prospect of recovery. The courts have stated that the theft loss deduction is suspended until the final amount of someone's loss is kind of like fixed, set in stone. With the vast majority of these types of scams, there is little to no prospect of recovery. The scammers are very sophisticated and they have tons of different accounts. They like move the money very, very quickly. As soon as the victim transfer the funds, it's gone. It's in some completely anonymous, random cryptocurrency wallet. So it can almost never be recovered. Every once in a while, though, maybe a governmental body is able to trace and seize some assets from a scammer and return it to victims. It may not be the entire amount that they lost, but it might be a portion. We've also had someone who was successful in a class action lawsuit against a cryptocurrency platform, where there were many scam victims that came together to sue a cryptocurrency platform, and they too received a recovery. And in that situation, because this victim initiated the steps of suing the cryptocurrency platform, etc., like kind of in the year of discovery, like he had a reasonable prospect of recovery. So his ability to deduct the theft loss was suspended for 3 years until the case was finally settled. He got a payout, and then we knew for sure what his actual loss was. And his loss was, what he had transferred plus the attorney's fees that he paid in the lawsuit minus what the cryptocurrency platform had paid back to him in a settlement. So again, it's normally, there's normally little to no possibility of recovery, but every once in a while, there may be some type of like reasonable, non-remote possibility of recovery. And in that situation, the loss deduction is suspended. Now, if someone takes a loss deduction and then later on down the line, law enforcement reaches out and says, hey, we seized these assets, some of it's yours, and they pay the victim some of that money, if the theft loss deduction has already been taken, then what happens is the victim then claims that recovery as income in the year that it was received.
All right. Thanks, Heather. We're running real tight on time, so let's try to hit these last two slides really quickly, just kind of high level, and then I think there's some questions in the Q&A and the chat that we can kind of wrap together, because I think there are some similar themes in some of the questions. So just a few collateral issues. Now, just, Heather and I have worked on dozens of these cases. When we say that, what we generally do is consult with individuals when they are considering taking the loss. So they've discovered that there's a loss, that their funds are not recoverable, and they want to consider taking that deduction on the return. And so we advise clients in that respect. But we also have worked with clients who have been audited, either for taking the deduction or for related reasons, and a few cases that have had to go to the U.S. tax court. We've had some success there with this kind of analysis and this transaction entered into for profit argument. But there are some issues that we sort of see along the way that are not kind of right in the fine lines. So, when we see retirement plan losses that are funded out of retirement plans or IRAs, uh, as with any distribution from those accounts, the participant's going to take that amount into income, so their AGI is going to be increased, and so that may, in some cases, put someone in a much higher tax bracket than they would expect. The 72T additional tax, I did see a question about this in the Q&A, because the 72T kind of 10% penalty, as we refer to it, is actually not a penalty. It's an additional tax that's calculated based on the amount of taxable income or excuse me, income distributed from the account. And because the deduction is actually a Schedule A itemized deduction, the deduction does not offset the 10% additional tax. That's we've talked to multiple CPAs. We've tried to sort of reason our way through this. What we've seen in IRS activity for our clients, we've seen this in two cases. The IRS is going to assert that the 10% additional tax, that 10% early withdrawal penalty, is still going to apply. And generally, again, because it's a statutory additional tax, it likely is not going to be abated. We talked a lot about basis earlier, so we're not going to worry about that. The zero basis question, except for the point of the last point, and this relates a little bit to the phishing scam that we talked about before. If the money comes directly out of a qualified plan or a pre-tax account, for example, a theft from the custodian, the participant's not generally going to have to take that distribution or that loss into that amount into income because they didn't request the withdrawal, but they also are not going to have a corresponding deduction. So where that really becomes kind of an unfortunate situation is in where, for example, an individual has an IRA that's a custodial IRA and it invests in commodities, for example, and those assets are stolen from the custodian, so stolen directly from the custodian. That is not an amount that's going to be included in income, but the individual is also not going to have a corresponding theft loss deduction. So, there's a challenge there. And then, what we sort of didn't talk about, and this hits some of the questions in the Q&A, this theft loss is an ordinary loss deduction. It's not a capital loss or an investment loss, so to speak. So it's not limited to $3,000 a year against ordinary income. It's deductible up to the amount of ordinary income as a Schedule A itemized deduction. But if the individual has income in excess of, or excuse me, has a loss in excess of the income, then that additional loss, the unused loss, will carry forward as a net operating loss. And the assessment statute for the years will be kept open as they normally are with net operating loss carry forwards. So just a little note on that. So I think we have one more slide and then we'll hit the question.
Yeah. All right. So some of the things that we have encountered in defending theft loss deductions with the IRS are like problems that we've seen arise. First, we have seen IRS appeals officers and just other IRS employees really confuse this theft loss deduction under 165C2 with the Ponzi scheme safe harbor. And of course, the safe harbor is only going to apply to Ponzi schemes that involve criminal charges being brought against a central figure. So for these types of scams, it doesn't work. But that doesn't mean it's not deductible. It just means that it doesn't fit into the Ponzi scheme safe harbor. So we have had some pushback from IRS employees who think that it must meet that safe harbor in order to be deductible, and that is not true. Like 100%, that's false. The normal deduction is under 165C2, and if it meets the deductibility checklist, then it's deductible. we've just kind of seen like some varying recognition or knowledge of the theft loss deduction and the chief counsel memorandum that we mentioned before among different IRS employees. And it may be kind of increasingly difficult, in my opinion, to defend these deductions, depending on the level of the IRS employee that you're dealing with. Like lower level employees may not have access to all these resources or may not be as highly trained, so they may not be aware of the law and how the IRS guidance. Higher level employees will have a better understanding, but so I think that some of these deductions that may get examined on lower levels may face a lot of issues. In our cases, we have been kind of like required to submit documentation tracing the money to show where it's coming from the victim's accounts to the purported investment platform, and to kind of give a clear explanation of the profit motive, like the investment, profit, etc. motive. And they want to kind of have a clear differentiation between that profit motive and any type of social, romantic, personal aspects involved in that scam. And then finally, when it comes to substantiating someone's profit motive, the reasonableness of that motive and the victim's actual intent are highly relevant here. All right, we should get into the Q&A because we have like 1 minute.
Yeah. So just spinning through them. So, the question about the differences between an investment loss or a theft loss, and I sort of touched on that before. If by investment loss you mean sort of a capital loss, I mean, two issues. Number one, generally in these situations there is no investment. Once the individual sends the money to the scammer, although they are demonstrated investment results, there's no investment. What we've seen through tracing is that the money usually is dispersed immediately to additional wallets. So it's never invested in any sort of capital asset like cryptocurrency, even though it looks like it is. So it wouldn't generate a capital loss. Of course, the issue there is that if you have a capital loss, it doesn't offset an IRA distribution, but an ordinary loss would, and the theft loss is an ordinary loss, and so it would do that. Again, up to the amount of the loss. A couple questions about the basis issue. So if money is transferred or taken directly from a pre-tax account where there's no basis, there's going to be a deductible amount of zero. But if money comes out of those accounts, it's going to be included in taxable income, which is generally going to generate basis for that. So we're going to have you would have basis there. Sorry, going through. The question about when the deductions can be taken. We have advised clients on amended returns in the past, so going back and filing an amended return within the statute of limitations for amending that return and claiming a refund. So we have done that, and generally, because this is an ordinary loss deduction, it can offset compensation income. So if someone has W-2 income from which payroll taxes were withheld, it would potentially generate a refund of those taxes. So in general, because it's an itemized deduction, I think it is going to be deductible in most states, right, Heather? For states who don't follow federal, there's a different question. We've worked with a client in Louisiana. Louisiana does not follow federal, but Louisiana has an identical theft loss statute in its tax code. So that is a question. And again, on the appreciation question, the key is, was there a recognition of the appreciation before the theft occurred? So if you have appreciated assets, Heather's example, where there's Bitcoin that our client purchased for a few $1,000s that had appreciated in value, and then that exact Bitcoin was stolen, that deduction's limited to the original cost, to the basis. But in a lot of these cases, we see clients taking money from IRAs or after-tax accounts, purchasing new cryptocurrency, and transmitting that cryptocurrency, that new currency, to the scammer. In that case, that current cost is going to be the deductible amount. So generally in those cases where it's new cryptocurrency or new money that's being transferred, there's going to be a basis equal to the value of the loss. Let's see, what am I missing in here, Heather? Did after the fact, we covered the appreciation. Yeah, if the deduction exceeds taxable income, there's a good question here. If it exceeds taxable income, the excess carries over to a future year. One question we've seen is that, and this is important to remember, a deduction is not the same as a credit. So if you have a deduction for a $500,000 loss, and that deduction is $500,000, you're not going to get a refund of $500,000 from the IRS. That's not how deductions work. What that means is that you're going to be able to avoid paying tax effectively on $500,000 of income. So if you think about a cash sort of equivalent, the deduction is only worth 30 cents on the dollar, or whatever your tax rate is, right? So for every dollar of deduction, you're saving 34 cents in tax, whatever your tax rate is. So it's not a refund. It's not a way for an individual to get their money back, because that's not how a deduction operates. We have encountered questions like that before. So let's see. Go ahead, Heather.
Okay.
Okay.
So one thing that I want to, because there's a couple questions on this, if there is longer than the normal 3-year period to amend the return to claim a theft loss that they did not realize the loss could be claimed. So normally, no, you just have that 3-year assessment statute of limitations to claim the theft loss deduction after, like, essentially what would have been the year of discovery. And if that passes, then there's really not much recourse. Someone also asked, Robert asked, if the 3-year statute could be extended due to being hospitalized. Like, there's a way that you can extend the refund statute of limitations based on financial disability. That's a little bit way more extreme than just hospitalization. I guess it depends on why someone is hospitalized. But I don't think the assessment statute of limitations is told in the same way, but there's definitely an argument, I think.
Yeah,
For
it would just sort of be the
disability.
normal statute of limitations rules that were there. You'd have to sort of fit under a normal reason for extending the statute. And generally, statutes, are in that case are there. There's a lot of jurisprudence here that we probably can't get into. We're pretty over time. I do want to just hit Judith's question about the victim not reporting it and no recovery. The reports are things that we would use to think about the validity of it being a theft, the locking in the timing of the loss deduction, because remember that the timing relates to when the loss was incurred, and theft losses are incurred in the year in which they're discovered. So that, there wouldn't be that there's no recovery. It's just a substantiation question at that point, right? And sometimes what we've seen is the IRS process these deductions, pay any associated refund to the taxpayer, and kind of go on. But as we mentioned, we've also seen these claims audited, and have had to defend them. And so it really is a matter of substantiation. So if that claim gets made and the IRS audits it, the question then is, okay, when did you determine it? When can it be deducted? Real quick, the net loss carry forward under current law is unlimited, so it can go forward as long as it needs to. Real quick, go ahead, Heather, because I think we got to probably wrap it up, but go ahead.
Yeah, Paul, you could definitely file a protective refund claim. Yeah. I mean, you might not need to. Well, no, you might not need to, because it's not like you're pending guidance or anything like that.
Yeah.
You just file the refund claim.
You just file the claim. All right. So we've had 1 or 2 questions in the chat or the Q&A about how to contact us. Our phone numbers and email addresses are on the screen. Generally, what we do consult with individuals to discuss this. If we generally then engage with clients in order to provide written advice related to substantiating the deduction. So generally, that's how we work with affected individuals in this case. So again, if anyone has any questions on this, feel free to reach out to Heather or to me, either by email or phone. We're happy to chat. And if you
or
need
if there's any
assistance.
questions that we didn't get to, etc. And then also they are going to send out a poll very quickly, just to kind of get your opinion on this presentation and presentation formats, etc., etc. So if you could please fill out the feedback poll very quickly. And after that, we are all done.
I think we're done.
Okay.
All right. So I don't know how long we need to leave that open.